Hey guys, Kanal here from Level Traders. So far in this video series, we have covered technical indicators like Fibonacci, moving averages, and volume. Today we're going to look at other supplementary indicators. I say supplementary because they should not be used in isolation to make trading decisions or generate trading ideas. So here's what we're going to cover. We're going to cover the MACD, the moving average convergence divergence, the stochastic, and the RSI, Relative Strength Index. So I'll go through exactly what these indicators are, how they can be used in trading, and we'll go through some examples. So first up, the MACD. So we know the MACD as a momentum indicator. The MACD is calculated by subtracting the 26-period moving average against the 12-period moving average. The result of this calculation is the MACD line. The example I have here in the blue line, you'll see in the bottom of the screen, that's the MACD line. Then there's a 9-day moving average of that MACD line called the signal line, and that's plotted on top of the MACD line, which can act as a function for triggers for buy and sell orders. So that's the pink line. If you want to know more about moving averages, why not check out my video where I cover this in more detail. For those that have seen my video on moving averages, you'll know that moving average itself is a lagging indicator. Therefore, by definition, the MACD is also a lagging indicator because it relies on the moving averages. Now you may ask, what is that histogram at the bottom? That histogram simply plots the difference between the MACD line and the signal line, i.e. between the blue and the pink line. If you look at the chart we have in front of us, you can see as the MACD line and the signal line separate, the histogram gets bigger. This is called a MACD divergence, where the MACD line is diverging away from the signal line. So let's recap what we know so far. So we know there's a MACD line, which is the difference between the 12-day moving average and the 26-day moving average. Then there's a signal line, which is a 9-day moving average of that MACD line. And then we've got this MACD histogram, which is plotting the difference between the two lines. So let's now look at an example. So I've got here a chart of Ford Motor Company. This is a daily chart between August 2020 and April 2021. Now if we look at the end of September, where price began a new uptrend, you can see the MACD line crossing the signal line at the beginning of October. This is a clear example of how the MACD is a lagging indicator. Now that doesn't mean this shouldn't be used, but traders should be aware of this limitation when using MACD for analysis. In terms of turning points, it actually moves quite well with price, or so it does using this chart. At the start of 2021, Ford began a new uptrend, and you can see the MACD line also began to turn up. However, if you look, it crossed the signal line about 8 days later. Then the other example I have is, if you look at the MACD line, it crosses the signal line mid-February, suggesting a new downtrend is in place. But look at what happens to price. Price actually rises during this period, while the MACD is decreasing. So this is clearly a false signal, and another reason why indicators should not be used in isolation for making trading decisions. Here's another example. I've got a chart here of Google's parent company, Alphabet. This is a weekly chart from January 2018 to April 2021. Now if we take the uptrend, which began in December 2018, you can see that the MACD line, i.e. the blue line, crosses the signal line, the pink line, at the start of 2019, which confirmed the new uptrend. Then the top in price in February 2020 saw the MACD line cross the signal line, i.e. a sign of a new downtrend. And you'll see the histogram bars are really big because the divergence between the signal line and the MACD line was big as well. And then finally, another top in price in late August 2021 saw the MACD line crossing the signal line at the start of September, starting a new mini downtrend. So from these examples that we've looked at, you can see the MACD does work quite well when finding turning points in price, but we should be aware of its limitations as well. Next up is the stochastic, which is another momentum indicator. The stochastic oscillator compares a particular closing price of a security to a range of its prices over a certain period of time. So the stochastic indicator tells us when the market is overbought or oversold, and usually the scale is between 0 and 100. So the rule is, when the stochastic lines are above 80, then it means the market is overbought. When the stochastic line is below 20, it means the market is oversold. Keep in mind that the stochastic can remain above 80 or below 20 for long periods of time. So just because the indicator says overbought doesn't mean you should just blindly sell. So for those eagle-eyed viewers, notice there are two lines similar to the MACD. One reflecting the actual value of the oscillator for each session. So that's the black line, or what is known as percentage K. And then there's one reflecting the 3-day moving average of that line, which is the pink dotted line. Now, similar to the MACD, when the two stochastic lines, i.e. percentage K, the black line, and the pink line, percentage D, cross, a signal is generated. So if the percentage K, the black line, crosses below the pink line, the percentage D line, a possible sell signal is generated. Now these crossovers may appear anywhere on this chart, but what's more stronger is the signals above 20 and 80. That's what I would use this for, this indicator. So let's now have a look at this example we have. So this is a chart of the DAX 30, which contains 30 blue chip companies in Germany. This is a weekly chart from 2018 to March 2021. So first thing I want to show is there were two oversold signals where the stochastic dipped below 20 level. From September to December 2018, look at how the oscillator remained below 20 compared to when price did eventually bottom out and begin a new uptrend. You can see that price turned at the end of the year in December compared to the oscillator, which remained oversold for multiple months. The other period was March 2020. Now here the oscillator worked well, as both price and the stochastic oscillator moved quickly and jumped quickly. I've also highlighted two periods where the oscillator was above 80, i.e. overbought. So the first example of this is between March and July 2019. Look at how the oscillator remains above 80, whilst price actually remains quite steady and moves sideways. This shows the stochastic oscillator's limitation in that it can remain overbought or oversold for long periods of time before price even does anything. The second example I have is between May and September 2020, where the same thing happened with the oscillator remaining overbought for months. Price did eventually fall in September. The point really to note here is, although the stochastic oscillator is a useful tool in predicting price turning movements, it can take time for price to actually play out. So this shouldn't be used in isolation for trading. Next up, the relative strength index, the RSI. So this is similar to the stochastic oscillator in that it is presented in the same way with a scale of 0 to 100. The slight difference here is the dividing line between overbought and oversold. So for example, overbought here for the RSI is 70 or above, and for oversold it's 30 or below. The other difference is that the RSI is calculated using average price gains or losses over a given period of time, whereas the stochastic oscillator uses closing price. The other thing to note is the default period for RSI is 14 periods. So let's now take a look at an example. So I've got here a chart of BP from November 2017 to December 2020. So the first thing I want to point out is the RSI went above 70 in November 2017 and in May 2018, suggesting BP was overbought. If we look at what happened to price, it did fall slightly. However, price did rebound to make a new high in September 2018, but notice the RSI didn't reach overbought this time around. This is because the RSI is a lagging indicator and it looks at the prior 14 periods where you can see price actually fell. If we now look at March 2020, where RSI fell sharply below 30, signaling BP was oversold. Now price did rebound, though not by much, as RSI went back into oversold territory late October before rebounding. On both occasions, the RSI being oversold did lead to a bounce in price. It's also worth noting that, like the stochastic oscillator, the RSI can remain overbought or oversold for an extended period without price actually doing anything. Here's one more example using RSI. This time it's a chart of Procter & Gamble covering the period December 2017 to February 2021. This is a weekly chart. So first thing to note, we can see that during the period February to June 2019, the RSI was in oversold territory or hovering on or near the 30 mark. However, if we compare that to price only began to tick up from late April, so the RSI remained oversold for some time. I've highlighted a similar example, but this time the RSI is overbought from mid-March to late September 2019. Price actually continued to rise during this period and eventually fell in February 2020. Just goes to show that relying on one indicator is not a good idea when making trading decisions. The final example I have, which worked really well, was when the RSI touched 30, i.e. oversold. Price also rebounded sharply as RSI climbed higher in March 2020, so this was a good example where RSI did work really well. The key thing to take away here is that no indicator works perfectly 100% of the time, which is why multiple factors should be considered when making trading decisions. In terms of which one do I use or find the most useful, I use both the MACD and the stochastic oscillator for analysis and making trading decisions. However, all of these indicators that I went through are supplementary. What I mean by that is I don't use any one of these indicators as my primary tool for trading, because as we've seen, the success rate is mixed. So what I'll do is I'll look to add more confidence, more bias by using these indicators in terms of my trading thought process and logic. Nevertheless, I hope you found this video useful and have a better insight into the three indicators that we looked at. So we looked at the MACD, the stochastic oscillator, and the RSI. Do subscribe if you find these videos useful so you don't miss any future content. Thanks again for watching. Take care, folks.